to our webinar today on news trading. This is going to be a really good one because what I'm going to show you today is a strategy that we used almost sort of probably about 10 years ago now that was super profitable. But then for various reasons, which we'll discuss throughout this webinar, it got to a point where it just wasn't profitable anymore. It wasn't something that could be done easily, shall we say. But with the introduction of some sort of new market conditions, if you like, and a new type of broker out there, this approach to trading is now back in vogue, and it's something that you can implement literally tomorrow, and it gives you a very high probability of success, which is what we like when trading, right? So first of all, the disclaimer, as always. The content of this webinar is not investment advice and should be used purely for educational purposes only. All participants are advised to seek their own counsel prior to investing or entering into any trade. Spread betting or any other type of financial trading carries a high level of risk to your capital, with the possibility of losing considerably more than your initial investment. The content of this webinar may not be suitable for all investors, and an individual should ensure that they are fully aware of the risks involved, and if necessary, you should seek the advice of an independent financial advisor. Okie dokie, I guess you all understand that, so we can move on. So a little bit about me, for those of you that don't know who I am. My name is Alex Ong, and I'm the co-founder of a website and of a company called Traders Corner. We've been established probably about 5 years now, and my brother and I have been trading for just over a decade. We've been guest speaker at various financial exhibitions around the world, quoted on the NASDAQ a couple of times, and we're trading coaches and mentors. And if you want to follow me on Twitter, my handle is @AlexOngUK. That's enough about me. Now let's get on to the good stuff. The stuff you are all here for, which is news trading. Now, what is news trading? Well, I've taken this excerpt from Wikipedia, and as trading the news is a technique to trade equities, currencies, and other financial instruments on the financial markets. Trading the news releases can be a significant tool for financial investors. Economic news reports often spur a strong short-term move in the markets, which may create trading opportunities for traders. All right, and that's ultimately what we're doing. So when we're trading the news, I'm not talking about fundamental analysis. I'm not talking about taking a long-term view on something. What we're discussing here is trading the reaction. So the short-term price movement, 15 minutes, 20 minutes after a particular news announcement, that's what we're looking for here. Now, as I said to you at the beginning of this webinar, when we first started trading, this approach was extremely popular and very profitable. And I kid you not, it was almost like having your very own personal ATM machine. There were two approaches to trading the news. Well, two that we looked at anyway. One was called straddling, and what that ultimately was putting orders either side of the market. So let's say 10 to 20 pips away from the current price, 60 seconds before the news, and then whichever way the news came out, your order would be hit. You'd be taken into a trade. You'd be taken into profit very quickly, and then you'd take your profit, and that would be it. And the great thing about trading the news, as I say here, is that you know when the moves are going to happen. So for retail traders, because some of you don't like to sit in front of the screen all day, you would like to know that you can come down at a certain time and expect some sort of a move. Well, that's exactly what trading the news does for you. If you were to go onto FX Street's calendar, for example, their economic calendar, you'd be able to see when every news announcement was due out. So you'd know that the first Friday of every month, you've got the non-farm payrolls. The Thursday before that, you've got interest rates and central bank meetings. All of these news reports, they're scheduled. You know when they're going to happen. So you know when you need to be in front of your screen, ready to take the trade. Okay? So what changed? If it was so great, what changed? Why could we no longer do it? There are a few reasons. First of all, brokers got wise to this form of arbitrage. Now, why do I call it arbitrage? Well, it's not really trading. All right, well, it is trading and it's not. What you're doing is you're taking advantage of, excuse me there, you're taking advantage of inefficiencies in the broker's pricing, if you like. So because brokers used to keep their spreads fixed, one second, because brokers used to keep their spreads fixed, you could basically get into a trade at any point in time, well, 60 seconds before the news, and ultimately you would get guaranteed to get into the trade and you'd be guaranteed to get out and you would make money. Now, what happened was ultimately, because the brokers, the reputable brokers anyway, they need to hedge your positions in the market. What they started to do was they would widen the spreads, so to protect themselves, which is, you know, completely fair enough. They're running a business. They need to be able to make money. They don't want to lose money. That's not to say the traders are trading against you, but they just needed to even up the playing field. Now, what they did by widening the spreads was, first of all, you would need a significant market movement in order to allow you to get into a trade. All right. So if the broker widened the spread by, let's say, 20 pips, you'd need the market to move at least 20 pips for you to be able to make any money, to be taken into profit. So that made that more difficult. I mentioned a technique called straddling earlier. So you'd put your entry orders 10 pips above and below the market, 60 seconds before the news. And with the brokers widening their spread, you'd be taken into both positions and end up, you know, making money on one but losing on the other. And what that ultimately did for you was ensured that you either came out of break even, you had a tiny profit, or you lost money. What also started to happen was the market volatility contracted. So, you know, back when we first started doing this nearly a decade ago, non-farm payrolls would move, and they still do sometimes today, but you could pretty much bet your life that the non-farm payrolls would move 150 pips. And it would move 150 pips in one direction, right? So you wouldn't have to worry too much about whipsaw. Go 150 pips in one direction. So if you got in, you straddled the market, let's say 10 pips beyond, you were guaranteed to make 100 pips on a trade, which was great. But when the volatility contracted and the moves weren't as significant, as pronounced as they once were, then suddenly it was a little bit harder to make your profit. So whereas you were getting into a trade previously with a very, very positive risk reward, now you were getting into trades where the risk reward wasn't necessarily that great, because with the brokers widening their spreads and then the volatility contracting, you get into a situation where there's very, very little profit on the table for you. And then finally, with the financial crisis and the safe haven trade, it became harder to trade the numbers because, you know, whereas before a positive non-farm payrolls number, for example, was positive for the US dollar. So you'd see the US dollar strengthen across the board. Easy enough to understand, right? Well, with the safe haven trade, what actually started to happen was, let's say, for example, you had a positive NFP number, which you rarely did anyway during the crisis. But let's say you did. Instead of the US dollar strengthening, actually the US dollar would begin to weaken, because that would signal some sort of a recovery, and you'd see people putting all of their money back into risky assets. They take their money out of the dollar, which was, you know, the safe haven currency, if you like. So it all became a little bit messy and a little bit more difficult to trade. Are you all with me so far? Do you understand what I'm talking about so far? You're all still awake after the history lesson? Okay, so what's changed in 2015? Well, first of all, there's a new type of broker. I don't know how many of you have heard of it, but there's something called a binary options broker. And what essentially they allow you to do is, they say it's trading, but ultimately you're just placing a bet on whether the market will be up or down after 1 minute, 2 minutes, 5 minutes, whatever it is. All right. So you can place a bet and say, after X amount of time, this market will be, you know, it will be higher or it'll be lower. So what does that mean? Just now I was talking about the fact that volatility contracted, the brokers widen their spreads, all of this kind of good stuff, which means you need the market to move a significant way for you to be able to make your money. With binary options, actually, you don't need the market to move that far at all. You just need it to move in a particular direction, which most news announcements do. So with the binary options broker, as long as you can, I don't want to say guess, or let's say as long as you can trade the right direction, you can pick the right direction, then you can make money. So as long as you say the market's going to be up after 1 minute, 2 minutes, 5 minutes, and it is up, even if it's 0.00001 of a pip up, then you will still make money. So the market doesn't have to move 10, 20, 30, 50 points. It just has to move. Now, the only problem with binary options brokers is the fact that it's a negative risk reward, all right? And especially trading around the news. So let's say, for example, you put down £100 on any one particular bet or trade, you would likely only return somewhere around £160. So that's £100 plus your 60 back. Now, what that means is you're in a negative risk reward situation. So you need 2 good trades to outweigh 1 bad trade, all right? But with this way of trading, it becomes so predictable that you have such a high strike rate that actually it is really quite profitable. So taking into account the introduction of binary options brokers, you no longer need a big move to make your money. Plus, with the recovery, all right, the world is no longer as focused on the safe haven trade, and the markets have become more predictable. So a good number for a particular country usually signifies a move, a strength in their currency. So it becomes a little bit more predictable as well. So how to trade the news now? Well, in today's world, we trade the same approaches we did 10 years ago, but now we use the binary options broker instead of a regular broker. Straddling is still not a viable option because the brokers still widen their spread, so it's not the best way to trade. But the key is to find the news announcements that have the potential to move in one direction with very little whipsaw. All right. Now, we don't mind whipsaw as long as it's within a time frame, because with binary options, there is no stop loss. You make a bet, and after a certain period of time, you're either right or wrong. So we don't mind a little bit of whipsaw, but what we don't want is we don't want news announcements that just go sideways. We want news announcements that have the potential to move in one direction only. So things, we're talking about the major announcements. So things like non-farm payrolls, interest rates, GDP, retail sales, PPI, CPI, things like that. They're the sorts of announcements that you want to be trading. All right. Once you've found the high impact announcements, then you want to look at identifying the right instruments for each announcement. So for example, if you're trading a US release, then you may opt to go for something like the dollar yen. If you're trading a euro release, then you'll be trading the euro dollar. If you're trading a pound release, a UK release, then you'll be trading sterling. Does that make sense to everybody? So with every announcement, you can't just trade the one currency pair across the board. You have to trade the one that makes the most sense. Does it have to be a news trade, or can you say the S&P? You can, with binary options, you can also say that some of the indices are higher or lower in 2 minutes. So you can use it for that as well. But in this webinar here, obviously, we're just talking about trading the news. So find a key news announcement and find the right instrument to trade that announcement. That's the first thing. Now, we are trading the reaction. All right, we are only trading the reaction. We're not trying to predict the way the currency is going to go. We're going to trade the reaction. So once the release has come out, once the numbers have hit the board, then we will take our trade. So once we've found the announcement and the currency pair that we're going to trade, what you need to do is you need to go back over the last 6 to 12 news releases. Now, I know this sounds like a lot of work, and to be honest, it is a lot of work in the beginning. But once you have all of these statistics, all right, once you have all the statistics that I'm going to show you here, then it's actually quite easy, because each month, each announcement that you trade, you update the numbers there and then, all right, and then it becomes much, much easier to trade. So you need to go back over the last 6 to 12 news releases, and you need to identify the open, the high, the low, and the close price for the 1 minute candle, for 2 minutes, 3 minutes, 5 minutes, 10 minutes, 15 minutes, and 30 minutes after the release. And at a minimum, you want the 1 minute, 5 minute, 15, and 30 minutes after the release. Now, why do we need all of those time frames? Ultimately, because every news release is different. So there will be some news releases where you get initially high impact and the market will move in your direction. So after a minute, you'll be in the money, you can take your profit. And there are other news releases where sometimes it can take a bit of time for it to pick the ultimate direction and then go in your favor. So what you need to do is you need to identify what is the most predictable time period for that particular news announcement and for that particular currency pair that you are trading. Does that make, does everybody follow there? You all still alive? Okay. So once you've got the open, high, low, and close for those different time periods after your trade, you then need to know what the expected number was for that particular month, for that release, and what the actual number was. Okay? Okay, Ray. So basically what I'm saying is that so you need to start gathering data. So for each news release, so let's talk about the non-farm payrolls, for example. For the non-farm payrolls, you want to get at least 6 to 12 months worth of data for that one release. And the data that you need to collect is the open, high, low, and close price for 1 minute after the 1 minute candle, after the news release, for the 2 minutes, 3 minutes, 5 minutes, 10 minutes, 15 minutes, and 30 minutes. All right. John, the brokers get there's like an interbank market. So there's a number of different major banks giving feeds, and that's where the brokers will get theirs from. Now, once you have the open, high, low, and close price, you then need to start looking at the numbers themselves. So for the non-farm payrolls over the last X amount of months, you want to know what was the expected number. So what was the market forecasting? And you can get all of this information from places like FX Street. So what was the number forecasting? And then what was the actual number that came out? Because what we do as news traders, we trade the difference from the actual number compared to the expectation. So you will see that there are some months when the market isn't very predictable. And you will then be able to tie into the fact that in that month, there wasn't actually that much of a difference between the expected number and the actual number. You mainly get a move in price when there's a significant difference between the actual number that's released and the number that the markets were expecting, because a lot of traders, they position themselves for a particular sort of number. Now, when that number isn't as expected, they then need to reposition themselves. And that's why you see such a big movement in the markets. All right. So as I say here in the last line, once you've got all of that information, you then need to try to determine what sort of a difference between the expected and the actual number causes a predictable move that is sustained over the course of any of the above timeframes here that we're talking about. So the 1 minute, 2 minute, 3 minute, 5 minute, 10 minute, etc. All right. So it's sort of like a little bit of a jigsaw puzzle. What you have to do is you've got to look at the different releases, look at the actual versus the expected, and look at how far price moved in those different time periods until you can find something that is predictable and something that tends to move in pretty much one direction. So here's an example of the said research. All right, this is an example for the Japanese yen. So for the dollar yen, and this is the NFPs. All right, so non-farm payrolls, these are the numbers we have for the non-farm payrolls over the last 12, how many months we got here? 1, 2, 3, 4, well, 10, 12 months. All right. So on the left, we've got the expected number. in the center here, we've got the actual number that came out, and then here we've got the difference. All right. So you've got the expected, the actual, and the difference. Then we've got the high and the low. I mean, I couldn't fit it all on the screen here, so we do have it for the 1 minute, 2 minute, 3 minute, 5 minute, etc. I couldn't fit it all to the screen here, so I've just got the 15 minutes for you. So we've got the high and the low for the 15 minutes. I've got that in terms of the difference. So rather than just the price here, I've got what was the difference from the open. So it went up 33 and then it went down 82. All right. And over here I've got the open, high, low, and close. So, and I have this for each month. So you've got the expected number, the actual, the difference, and then we've got the high and the low, and then the open, high, low, and close prices here on the right. So what I'm able to do from this is I'm able to go down this column here, and I can look at the differences. All right. So I can see there a negative 120 difference caused a move, which after 15 minutes, the high was 82 pips. The low was, the high was 33 pips. The low was 82 pips. All right. But the close after that period of time, it closed pretty much where it opened. And there may be other factors there that affected that as well. I can see that the next month, there was a difference of 72. Okay, so it's negative 72. It went up 3 pips before it went down 92 pips. All right. And I can see here that the close was about 50 or so pips below my entry price. And if I go on here, I can see that a positive number. So the actual was 24 better than the expected. And what happens is that it goes down -4 pips before it goes up 69 pips. And as I can see here, the market closed about 68 pips above where it opened. So now I'm starting to see a pattern, right? I can see that any sort of a real difference in the price does cause a move, and it causes a move of 50 pips or more, which is what I like to see. We see here that there's only a difference of -1, and the market closed 5 pips higher than it opened. So there was really no sort of significant movement there. So what we can get from this is we can say that, okay, looking at this generally, I can say that as long as there's a difference of 20K or more, all right, so if there's a difference of 20,000 or more in terms of jobs and the non-farm payroll releases, I can take a trade and I can expect the market to move roughly on average 50 pips in either direction. Now, this isn't going to work every single month. If it was, we could all print money. So there will be months when the numbers do not quite stack up like that. So you need to be looking for things like revisions when the numbers come out. So if you get a revision that's significantly different to the actual number that you've got here, so a revision from the last month. So let's say you get a positive number here, but a negative revision from the last month, then you've got two forces fighting against each other. And that can cause whipsaws. And that's why you see things like when there was a 120K difference here, the market pretty much, sorry, not this one here. Where was I looking? There was one here. Yeah, okay, so when we had a -20K difference here, the market pretty much only ended up 13 pips below where it started. Now that may be because there was a positive revision from the month before. So these are things that you have to keep your eye on. But as you can see, by keeping statistics like this, you can actually create something that is relatively predictable. You won't win every single trade, but you'll probably win 8 out of 10 of your trades, or maybe even 9 out of 10. But it will be a significantly high strike rate. It'll be something that's consistent enough for you to be able to make money. And what's better is that by trading this particular way, you know when to take a trade. You know that you don't have to be at your trading station. You don't need to be at your PC until, let's say, 5 or 10 minutes before the news. That's all you need to do. You turn up 5 or 10 minutes before, you look at your statistics, you know what to expect, you get your orders ready, and then you trade. And then 5 or 10 minutes after the news, you're done. That's it. You're finished for the day. You can even walk away from your screen as soon as you've got your trade on. So this approach to trading, yes, it takes some work initially. So you need to compile all of these numbers here. This is something that you can't get away from. My brother and I do it, and we keep up-to-date numbers on all of the major news releases for 6 or 7 different economies. And it is hard work in the beginning, but once you get all of that information, then you'll find that you've got a trading system that's 1, predictable, 2, requires very, very little effort, and yeah, so a very, very nice trading system. So trading the reaction. Once you've completed all of that research, right, what happens when you're actually sat in front of your trading screen? What do you do? So once you've completed your research and you've identified the releases that are tradable, along with the time periods from which you want to trade them, you're ready to execute in the market. So on the day of the release, you'll turn up to your charts probably 5 minutes before the release. Okay. And as I said just now, you'll look through all of your research and you'll identify what sort of a number you're looking for to be able to take the trade, because if it comes in as expected, obviously you're not going to take the trade. And sorry, what was that? I don't know any binary broker. Would you give me Yeah, as I said, Alexander, all binary options brokers, that's the downside. It's always a negative risk reward, unfortunately. So where was I? So on the day of the release, you want to be in front of your charts 5 minutes before. You'll identify your benchmark, if you like, your watermark, where the release has to come out in order for you to be able to take a trade. And then you can bracket your range. So you can say, put in a support and resistance line, 10 or 20 pips above the market, 10 or 20 pips below the market, or 50 pips, or however far it is that that the market moves after a certain amount of time. Now, the reason for this is we're not trying to trade through it. Right, that's important. I'll come to that in a minute when I show you the charts. We're not trying to trade through the lines. We're putting those lines there to help us identify where we can take a trade. So we can take a trade if the market is within those lines, because we expect the market to be above or below those lines after a certain period of time based on our research. All right, but I'll show you a chart in a second. So your trading platforms have to be opened. Then you need a news service. So something like Trade the News or Forex Factory do sort of like a semi-news service now on their calendar. You can use that if you don't want to pay a monthly subscription, but we use Trade the News. So you need some way of finding out what the actual number is. And then, as I put here, you need to place a resistance line X pips above the current market to signify where the market would have moved too far for a profit, and do the same with the support line beneath the market. And that is exactly what I have here. So you then wait for the announcement, and as long as the difference is great enough, according to your analysis, and the market hasn't moved through your support or resistance line. So here we can send this chart here. This is the dollar-yen chart for this month's non-farm payrolls. And as you can see here, the entry price was around 120.50. So we bracketed. We know that the non-farm payrolls will cause a move of about, or at least 50 pips in either direction if the numbers are, if the actual number is 20,000 different from the expected number. So what we do is we put a horizontal resistance line 50 pips above the market and 50 pips below the market. So we know if we get a positive number, all right, then the market is going to fall off a cliff and it will go, so this is the dollar yen, so the dollar will strengthen. If we get a negative number, then the yen is likely to strengthen, all right? And that's ultimately how you trade it. So when we take this trade here, this one was more than easy to take. We generally take most of the news releases, we trade it for 5 minutes after the release. So we'll get to maybe 5 or 10 seconds after the release, and that particular contract will expire 5 minutes after we enter. So as you can see here, we get in roughly around this level here, around the 120.50, and the market rallies up really quite significantly and finishes way above our entry price, and that pays us. And you can do this for any number of news releases across the board. Okay. So summary. News trading is a great way to trade and extremely consistent as long as you take the right approach and put in the necessary research. You must find tradable instruments and news releases. They go hand in hand. And the work is put in before you even get to the chart. So with this particular trading approach, all of the heavy lifting takes place in all of the research and analysis that you do beforehand. But once you've mastered this, okay, sorry, I've got a mind blank there. So once you've mastered this strategy, you can rely on the fact that you've got a specific schedule, all right, that doesn't involve you sitting in front of the screen for hours upon hours on end, and you've got a relatively consistent return. Did everybody follow that? So now I will open up the floor to any questions that you have. All right. Obviously, I've got Merry Christmas here because I don't want to go about wishing you a Merry Christmas. So if you've got any questions, please feel free to ask me. And if you want any information on us, there's a link there as well. All right. Alex, when do you enter the trade? Literally as quickly as I can after the numbers have been released. So as quickly as my mind can decipher what's happened within the markets, I'm into a trade. Well, I just gave you a specific example, Manoy, the non-farm payrolls that had the prices there. Literally, if we went back a couple of slides, and this will be recorded if you want to go back and take a look at it. The brokers typically give you around news releases. You'll probably get, let's pick a round number. So for every £100 that you bet, you will get obviously your stake back plus about 60%. So it's about 60, it's just under half of what your risk is, or just over half of what your risk is. Regarding a binary options broker, the ones that we use is binary.com. I've heard horror stories with others. We also use IG Index, by the way. They've got something called sprint markets, which work quite well. But binary or IG. Yeah, and the price moves very quickly, but it doesn't just open in one place and close in the next. All right, so you do have time to get into these trades, but that's why you put the support and the resistance line into the market, so you know if it's above that line, you don't want to be into the trade. So if the market does, for whatever reason, move that quickly, and it's past your support or resistance line, then you don't take the trade. No, Manoy, there's no spread at all. And by the way, the live trading room is something that our members, I know a few of you are on here today, have asked us for in the past, asked us to put into place. We've got, and it's something that we're planning on launching in around March time. And the primary focus will be teaching people this and one other strategy. So we'll give you all of our research for each of the trades, which will obviously help you a great deal. No, at news time you get relatively quick execution with the binary options brokers, almost instant. So you don't have a pending order. I can't, or can I? I don't know if can I copy and paste? Can try. There we go. Oh, it worked. I believe it is being recorded. Yes. So are there any other questions on that? Does anybody trade this way already? Oops. To all attendees. That's because I didn't send it to you. There we go. Can you see the link now? As I said, we'll be launching this in March type time. So if you are interested, then just put yourself on the waiting list. We're not going to take thousands and thousands of people because, one, we don't have the infrastructure to do it, and two, it'll be way too many people to manage. So we'll do it on a first come, first served basis. So you either win or lose according to whether the price is higher or lower than that of the start of your trade entry. It doesn't matter by how much it is higher or lower. Exactly, Manoy. That's why we can now trade this way again. So even if the market moves 1 pip higher, you will make money. Even if it's half a pip or a tenth of a pip, as long as it's higher than the entry price, you will make money. Some releases where you can get a predictable outcome after 15 minutes, but the first sort of 5 and 10 are a little bit more unpredictable, in which case we'll go for a 15-minute expiry. Can you close contract before expiration? No, unfortunately not. Well, not with the brokers that we use anyway, maybe other places. And you plan to trade this system in the trading room? Yes, exactly. So the idea is that we aren't, it's not going to be, you know, a trading room where you just have to sit there all day. We've taken into account the fact that people don't want to do that most people can dedicate maybe half an hour of their day or an hour of their day or something like that. And they want it to be predictable. And everything that my brother and I do, we always want to give value to our members, if you like. So we don't want them to turn up for hours on end and do nothing. So we decided that this is really the best approach. So being able to deliver the best value. So we can give specific times when we're going to be there to trade. And we'll get together and we'll trade the news releases. You have to remember, we can't give you signals as such. We can tell you what we're going to do, but it's still down to you whether you want to take the trade or not. We're not going to say to you, take this trade now. We'll talk through our analysis. We'll give you our analysis, talk through what we're looking to do, and then you have to make your own decisions based on that. Does that make sense, John? Brian, you know what your expiry time is going to be before you even get into the trade. So your research will have told you that predictable market movements come X minutes after a particular release. You know, so for NFPs, you know, we know that 15 minutes afterwards we can get a predictable outcome. For other ones, it may be less time, but your research will tell you that. Manoy, at the moment, no, I haven't found that, but I only trade with the larger ones. So binary.com and IG Index, they're huge companies. So I don't trade with the binary options broker run out of the back of someone's garage. So how's everybody found this session? Have you found this useful? We're coming to the end of it now. We've got about another 2 minutes before we get kicked off. Is this something you think you're going to take a look into? Is this an approach that you think you might look into learning? Yeah, it's not bad fading the initial spike. That's another approach. The great thing with this approach to trading, all right, And I need to caveat this by saying that this isn't, you know, my favorite approach to trading. My favorite approach is the stuff that I do with the DAX. But this is something that we do like doing. And the reason that it's so great is that you know when to take a trade. You know that this news release is coming out at 8:30 in the morning. So you need to be at your screen for 8:30 in the morning. Once it's been and gone, that's it. You're good. You can walk away, and that's you done until the next release. So yes. Okay, people. Well, we're about a minute away from our allotted time, so I will thank everybody here for turning up. I wish you all a very, very Merry Christmas. Have not even set up MT4 early, Patrick. Okay. I wish you all a very Merry Christmas. And if you need anything, drop us an email or something like that. Thank FX Street as well thank you for having us. It's been emotional. It's been a great 2014. And hopefully we'll be back in 2015 with more good stuff, more strategies, more tips and tricks to make you all profitable traders. Okay, so thank you very much for having me. Merry Christmas and very, very Happy New Year. Take care now.